The last group of ratios are equity and market ratios. And this is what do investors expect to see from investments from the company stock. We have three measures in this particular grouping. First is dividend payoff ratio. Next is dividend yield and PE. Dividend payout simply means of the money we earn, how much do we pay out by way of dividends? Answer, dividends declared divided by net income equals dividends declared divided by net income. Now we can copy this over and see it over a 3-year period. So it went from 47 to 52 to 26, which means this year we made so much money, we kept the dividend payout relatively the same, which made the ratio go down. So we only paid out 27% of net income for dividends this year. Next measure is dividend yield, which is dividend declared for last year divided by the ending stock price. We use ending stock price just as a matter of convenience. So we do the end of the year and we look at the last trading day, what was the ratios, right? And that's why we're doing it based on ending for that year. Calculation we do from scratch equals the dividends paid per share, which is $1.20, divided by the stock price. So if we were to spend, in this case, $55 a share, and we get the dividend yield that we had the prior year, we would earn 2.7% on our investment. And this one, if we go back in time, it went from 2.9 to 2.3, 2.7. So I guess that's better than bank interest rates these days, but it's not a very high percentage of dividend payout. So they keep most of their dividends, and as a percent of return, it's a modest return you get from cash dividends, which means that people buy Intel stock, not just for cash dividends, but they buy it because they see that the stock price may go up. So now we have two ways to make money as an investor. We collect dividends, and we get money by way of a stock price going up, and we sell it and earn a profit, right? Two ways. We call it dividend yield and capital appreciation. Last one is price earnings ratio, and that is the price of the stock divided by earnings of the stock. And we usually do those in a per share way, but we can use either way, either the total amount of market value for the company divided by the total earnings that we had for the company, or what's simpler to use is the per share amounts. And let's do that. Equals share price divided by the earnings per share. And we can copy that percent across. And we see that we used to have pretty high PE ratio of 17, then went to 23, down to 9. That means for every dollar of EPS, how much is the stock price? And here it's only 9.9. Growth companies have very high PEs. Very stable, mature companies have lower PEs. And in this case, Intel's higher, I'd say, than the lowest, but is certainly looking at more maturity in the stock, right? So that's what we see, that the company is quite healthy and the dividend yield is stable. And the only possible negative is that the price earnings ratio went down, which means the investors are not quite as bullish in 2018 as they were in 2017.